Hello, I'm Glenn Mullan, President and CEO of Val-d'Or Mining Corporation. We work in early-stage grassroots mining exploration, mostly in Quebec and Ontario, Canada, following a model that some refer to as prospect generation.
Glenn, good to see you. Been a while. And look, I appreciate you coming back on the platform. Look, we've met previously. You've done a couple of exits, and I maybe want to talk about what you're trying to do here. Can you sort of explain the model in a little bit more detail for me?
Yeah, what we're trying to do is something that we've done somewhat successfully in the past 3 times. So a company called Canadian Royalties Inc., which still exists, was focused on nickel, copper, platinum group elements in northern Quebec. We had 122 royalties, grassroots royalties. Each one of them was paying $10,000 a year as advance on royalty payments. So 122 times 10,000. We actually had revenue when we formed that company to the tune of over $1 million a year. We were listed on the old Alberta Stock Exchange. And within 2 years, we were listed on the TSXV, as it was called then, the Toronto Stock Exchange, grew our market cap to $500 million, and were taken over by a Chinese metals company called Jialenjin from Jialan province in China. They still operate Canadian royalties in Canada, which has 1,200 employees, has been mining for 15 years, and has extended the mine life for another decade just a few months ago. So all of their work has been done on the original Canadian royalties properties, which followed this model. We followed that. Now, that was a hostile takeover. So there was a lesson learned in both capital markets and geology. Namely, although I was the major shareholder and had Norilsk Nickel, pretty well-known and venerable name in the nickel industry, and the Quebec government institutions all as shareholders, I lost in a hostile takeover. So the lesson learned was control your capital structure. And therefore, we formed Golden Valley Mines, named after the town I live in, Val-d'Or. So Golden Valley immediately did a triple spin-out on the venture exchange, forming 3 other public companies, of which the pitch today comes from Val-d'Or Mining Corp. So that's one of the 3. The other one was a royalties company called Abitibi Royalties. And through our good fortune and hopefully some good geological work, Abitibi Royalties went from 30 cents to $25.50. Golden Valley went to $12.65. They were both taken over by Gold Royalty Corp. And that left Val-d'Or Mining Corp to continue the exact same plan. So we stake properties. We acquire properties under the Mining Act in Quebec and Ontario. Typically, we own 100% on day one. We follow that with minimal work funded from our own treasury. Our real raison d'etre, or the real reason and business plan, is we try to find arm's length third parties, public companies, to do the heavy lifting, the financing, the drilling. To work on over 50 properties at any one time, most prospect generators have a basket of properties. You don't know if any of them are any good or all of them are good. In any event, it takes a lot of capital to test a basket. So typically we take groups of properties, divided by commodities, divided by geography, divided by previous history, and we find a partner to take a group of properties. And so our main partnership right now is with Eldorado Gold, a substantial major. Eldorado are our partner through 5 agreements on 12 properties in Quebec and Ontario, 2 in Quebec, 10 in Ontario. They're actually spending 36.5 million Canadian dollars to earn their interest. So going back about a couple of months, if you looked at Val-d'Or Mining Corp with a 5-cent share price, how much dilution would we have undertaken to acquire $36.5 million if we even could, which the market clearly said you could not. So that's the advantage to shareholders of the business model. It's non-dilutive for the most part. We've come up with a partner that can afford drilling on all of the properties. We've started on 2 of the 12 properties, drilling programs. And it's been great to work with Eldorado Gold. We're already in the 4th year of a 5-year agreement, the original one, and there are 4 more agreements that are staggered behind that chronologically. So that's the general model. We acquire properties on 100%, find a partner to undertake the expensive part of exploration. If we're lucky, if they vest and actually complete the earn-in terms, we're left with royalties. What we're trying to do is to create a royalties company. Ultimately, those agreements or exit strategies, selling to Gold Royalty Corp, Abitibi Royalties, Golden Valley Mines, Canadian Royalties before that, selling the companies as royalties entities tends to be better for shareholders than conventional mining deals on a property basis.
Okay, understood. So, but I want to be clear and I want to knock a few things off the table here. So Eldorado Gold, obviously, what, a $5 billion bucks market cap company. Kirkland Lake as well, I think also in there. Kirkland Lake Discoveries, I should say, smaller company, but a similar sort of structure. So in terms of how do you attract companies like Eldorado Gold, when you say you do minimal work, you can't just like stake it and then start advertising. What sort of work do you do to make it attractive to them?
Right. Well, that was actually an easier pitch. Some of the complications, no stories are perfect, and neither was the Golden Valley Abitibi story. But we were a grassroots explorer in those days. And in fact, we'd raised and had spent $10 million on this basket of properties in the Abitibi Greenstone Belt. Through good fortune, one of the properties, which ultimately has become the Odyssey Mine, owned and operated by Agnico Eagle, that was the former Abitibi Royalties property. It took off and took the share price with it, and the results were spectacular. But that caused the parent company, Golden Valley, to look at itself and say, well, why should we be raising money and diluting to continue grassroots exploration when doing nothing, protecting the capital structure, is a better defensive posture to take because the share price is increasing anyway. And it's not through exploration that we're doing. It was through exploration that Agnico Eagle and Osisko before that were doing. So, all that to say that we had $10 million spent on a group of properties, and Val-d'Or Mining Corp ended up acquiring those properties. So the pitch to Eldorado Gold was not the normal junior mining. Imagine, if you will, these are the scenarios. It wasn't quite like that. It was, this is what $10 million that we've spent over the past 10 years looks like on a group of properties. We actually have good results, including drill intercepts. We actually have spectacular untested geophysical anomalies that fit within the regional context. What we don't have is adequate capital funding to test them ourselves. And so they embarked on that basis. So these were grassroots properties insofar as none of them have resources. They're better than your run-of-the-mill grassroots properties because they actually had drill intercepts and a bunch of other work we were building through the previous 10 years with Golden Valley Mines. So that's Val-d'Or Mining Corp's property portfolio now.
Okay, so maybe a slight outlier, but let's deal with this in terms of right, Eldorado. You're a small company; they're a massive company. Surely they're on the front foot, albeit you're only looking for an NSR off the back of this thing. Are there any other kind of revenue streams en route? Are you using any exploration work? Have you got a management fee here, or is it just purely about letting them have access to the property and doing what they want to do and then sitting back and waiting?
You've clearly done your homework, including reading the management discussion and analysis and all the financial statements notes, which not many people do, but kudos. So yes, we have 3 revenue streams. One of them would be option payments. So there are 12 properties vended in total to Eldorado Gold. Each one of them has an option payment on an annual basis. So that's a revenue stream. It's not going to make the company rich or shareholders necessarily delighted by that by itself, but it's around $200,000 a year for the Eldorado joint ventures. Our agreements with other junior companies are similar. There's always option payments. Juniors, typically shares, equity-based payments, modest cash, majors, more cash. The more important one to our shareholders and to our little office in Val-d'Or is that Eldorado are the operator on the Quebec properties, of which there are 2. And that's logical given that their platform in Canada is the Lamaque Sigma complex, which is in the town of Val-d'Or. So it's logical that this property just north of the town will have them as the operator with their infrastructure, their geologists, their assay labs, etc. We are the operator on the 10 properties in Ontario, to which we're entitled a management fee of 10% of expenditures. And given that most of the $36.5 million will be spent on the 10 properties, it's not a straight line, 10% times 30 million or so, but it's very close to that if they go to term on all of the agreements as they now stand. So the option fees are an important source of revenue for our staffing. And separate from that, we own an office building in Val-d'Or, and we use tenants, standard leasing, as part of our revenue generation as well.
Some of the other companies who kind of have got similar models, they also say as well as the 10% management fee, there's a kind of component of being able to expense certain components on top of the 10%. So, in their case, they're examining that 10% is more like 12 or 14%, depending on the actual project.
Yeah, and that's true because there's certain benefits through infrastructure that we already own and operate in Quebec and Ontario. So a lot of that provides additional parallel or collateral benefits, things that would be more than simple synergies that are actually accretive. And often one program dovetails into multiple programs. But Eldorado Gold, the question that I'm most frequently asked is, well, why would they need a company like Val-d'Or Mining Corp when they clearly have the financial capacity themselves? The logical answer is, looking at a map of title holders, mining property owners in Quebec and Ontario, you would be left with the impression Agnico Eagle own it all. And they certainly have done a good job on consolidations, mergers and acquisitions, Kirkland Lake Gold, to name but a few, but they've probably acquired 60% of most of the favorable geology in Quebec and Ontario. And in particular, in a place like Val-d'Or, they effectively own all of the town and the surrounding areas. So Eldorado Gold are quite limited with the Sigma-Lamaque project. And although their ambition is to expand in Quebec, now their ambition is more clearly stated as within the Abitibi, which implies Ontario. And so we were fortunate that over 20-odd years, Golden Valley Mines, Abitibi, now Val-d'Or Mining Corp, we've consistently focused on northeastern Ontario. We always worked on both sides of the provincial boundary. Time to time, Quebec has been more favorable, fiscal stimuli, regulations, politics, etc. From time to time, Ontario has been more favorable, such as the present time. And Eldorado Gold were quick to recognize that the geology doesn't distinguish between Franco, Anglo, tall, short, felsic, mafic. It doesn't recognize that at all. It's economic geology that speaks for itself. And so our sales pitch was really geology. That's an echo of the geology in Val-d'Or, but in Ontario, Kirkland Lake and Matachewan specifically, and that's become their platform for Eastern Canadian exploration.
And I think the other component there is that the larger companies find it's more expensive to actually do their own exploration. Seems to be an answer that I get a lot as well. You haven't kind of gone into the third leg of the revenue stool, as we'll call it, which is obviously NSRs and how they get agreed and the quantum there. How do you work out whether it's 0.25 or whether it's 2.5?
Well, that's a case by case basis, and clearly operators want the lowest number possible, and the vendor wants the highest number possible. Historically, we saw numbers over 3%. Net smelter returns were quite common. Conventional numbers are closer to 1.5 or 2. And as the price of gold increase, there's probably less squawking from the seniors than there was before. It becomes very accretive anyway. Only 5 years ago, it was doubtful that the Odyssey mine would become a mine because of the royalties burden. Osisko had sold it and retained a 5% NSR. So there's a royalties company that was able to retain a royalty for itself as part of a divestment. That was when Agnico and Yamana were purchasing Osisko. but they created a royalties company that retained 5%. But that was on top of the 3% that we already owned with Abitibi Royalties. So an 8% NSR over different parts of the ore body. There were a lot of questions when the price of gold was $1,600 US and so on. And well, maybe we can renegotiate, maybe we should be talking, etc. Those talks kind of subsided as the price of gold kept moving up. And now we don't hear much about that anymore. But how do you do it on a case-by-case basis? Geology and legacy. So a company that has zero investment that wants a royalty, well, that's one end of the spectrum. The other end is if you've been there for decades, spent millions on the properties and have a legitimate interest, it's reasonable for shareholders to expect that there'll be an ongoing revenue stream through the royalty. There's a more leniency, I think, for legacy royalties to persist than new royalties to be created just to take advantage of the increase of the price of gold.
Okay. So we talked about Eldorado, obviously big boy in the room, 800 pound gorilla. Companies like Kirkland Lake Discoveries, I don't know them. I got a sense of from the size of the company, maybe, some of it'd be slightly more restrictive in terms of the capital allocation. So when you do deals with companies like that, you said there's some similarities in terms of option payments. There'll be some similarities in terms of presumably if they would want you to operate. But how do you vet them? Because you'll have, over the years, you've won a few and you've lost a few in terms of companies coming in thinking they're going to be able to raise the money to do what they say they're going to do. So how do you vet them, and how do you kind of monitor that situation?
Right. Well, that's really a story about managing expectations. When nickel was $24 a pound US, every nickel project was going to be a mine, and there was a long list of potential suitors. Nickel down at $4 a pound US, the line is not so long. And the price of gold is the exact opposite. So every day right now a new high, so the climate is a nice frothy one, and everybody's friends, and all these gold projects will be mines. Absolutely 100%. No, it won't work like that. But be that as it may, it's a property by property basis. So within our portfolio of over 50 properties, there are always a few that are getting a little too mature that require work in order to keep them. Additional assessment work under the mining acts, etc. And that's gradational. The amounts required increase over time. The longer you have it, the more you have to spend. It's the use it or lose it philosophy that the governments use for the Mining Act. And so some of our properties were coming due about a year ago, and Kirkland Lake Discoveries had already undertaken discussions about a geological model looking for critical and strategic minerals in a place where we'd had some historic success, historic being 1989, a drill hole that we had drilled back then that was very promising, 73 feet, so feet, not meters. That takes you back to the period of time, over 2.5% copper and 2.8% zinc, some spectacular grades. Continuous, volcanogenic, massive sulfide environment. And of course, the holes on either side did not meet expectations, so too bad, so sad, and on to the next one. Except that's one of those ones you keep thinking about, and you're thinking, well, it was there. Where's the rest of it? We have all these untested geophysical anomalies. It then became a budget story where we never quite had a budget adequate to test it until Kirkland Lake Discoveries came to us a few months ago, and it was just before the March PDAC convention that they came up with the idea to test for critical and strategic minerals within this same environment. And so those claims were coming due within a year if we wouldn't have done new work. So that was a motivation. The original program and discussions were, well, you have to drill at least 3,000 meters. Option payments aren't going to happen. Another junior company, even smaller than us, they're not going to make significant cash payments. I think we did end up with 1.7 million shares of Kirkland Lake Discoveries, KLDC. So 1.7 million shares and a drilling commitment and a royalty. Well, that's what looks like success to me in the prospect generation business. And off to the races they go. They came up with some promising results, went to the market at the perfect time in the rising climate, and announced a $10 million financing, oversubscribed, upsized to $14 million. Robert McEwen, Eric Sprott, all the names in the business that, imply success and good due diligence are on their shareholders list. So that has given them some trajectory and made our 1.7 million shares worth something at the same time. So that's one example, but it was really driven by assessment work under the Mining Act. We would have lost the properties if we wouldn't have done a transaction. And that's part of the motivation to talk to everybody. Of course, you want Agnico Eagle to be your partner on all the gold projects, or Eldorado Gold, or IM Gold. But if they're not interested in grassroots, we just keep making the phone calls, and you never know where success comes from.
What are the components that you write into these agreements with the smaller companies to protect yourself going forward? Because ultimately, if they fall over, you want to regain 100% control and ownership of the asset, right? So, but what does that look like? What are the other things that you need to be aware of to make sure that you put into that agreement?
Over 30 odd years, you're only the second person to ask me that question. So really, the trigger for us is an advance on royalties payment. And I mentioned that before. We used that with Canadian Royalties Inc. way back when. The advance on royalties becomes a source of revenue generation on the one hand, but on the other, it also protects the vendor. When the optionee goes sideways or goes into default or goes bankrupt, that's how we get the property back. I won't say it's never really theirs. They vest, they own it, subject to annual advance on royalty payments. If they fail to meet the advance on royalties, that's the opportunity to take the asset back. And so that's one way that we protect ourselves. And also staged increments and expenditures. There's no point in asking a junior company smaller than us for something that you know that they can't do. So 500 million to earn 51%, that won't happen with a junior tiny company. We tend to go for larger amounts with larger companies, but even there, they're based on capacity and real geology. What we determine to be, what would we do if we had a budget to do that ourselves? Those become the real numbers that drive agreements for milestones, renewals, tax payments, etc. But for the most small companies, it's always annual milestones. So payments to us in shares, but payments in terms of assessment work. There's minimums that they must do on an annual basis. And if they don't, well, that's the opportunity to reclaim the property. The vesting doesn't occur until all the expenditures have been made. That's where the royalty is created.
Okay. I guess like owning a house, if you've got a mortgage, you don't own it till you pay that mortgage off.
And if you pay 80% of it and you stop, too bad,
you
so
still
sad.
don't own it. Yeah, exactly. So put in everyday language. I mean, the other thing is you said right up out of the gate, you said like, you're protecting your shareholders here. We look to spend as little as possible on these, this land that we have staked. What does that actually mean? And when you say as little as possible, if we enter conversations with Eldorado, with Kirkland's and anyone else you're talking to, what's the sort of minimum spend? I guess you're going to say case by case, but can you give me a sort of range?
Right.
Where minimum means minimum.
For 2025, our real exploration budget, including sources such as Kirkland Lake Discoveries and Eldorado Gold, etc. What are people spending on our properties, whether it's us directly or through us? Well, that's in the range of $5 million for this year.
Glenn, let me be clear. I'm talking about you with your shareholder money. Was the minimum that you look to spend? Because I get using other people's money. That's smart.
We're spending $300,000 from our own treasury this year, and the $300,000 is distributed amongst 10 different properties. Not big amounts, an average of $30,000 per property, which is enough to do geophysics, geology, prospecting, sampling, a little bit of verification if there are historical assays. We don't want to look like total dummies. If there's something that's unreasonable, it needs to be looked at on the ground. $30,000 per property. This is a part of the world you can drive to. No helicopters, very cheap exploration. So those are real numbers, and that pays for 10 properties to be moved up the dial to the extent that we think we can find an optionee for each one of those. So we only spend money on properties we expect to vend to someone else.
Okay, so you're not burning through a whole bunch of cash. That's good news for your shareholders. Can I look at again, going back to, like, you've done it a few times before, I'm trying to work out, and maybe if you could help us understand where value starts to kind of creep into, what you're doing. Because it's going to get rich slow scheme, but you get rich. That's the good news. As these NSRs come in place, as the companies spend money, I guess there should be value attributed. So what does that tend to look like? What are those kind of stepping points?
Right. So I think the Eldorado agreement is actually a good one for the purposes of this discussion as well. So over the previous 3.5 years, there really weren't very many news releases from Val-d'Or Mining Corp about what we were actually doing there, except what was disclosed in the MD&A and the financial statements, because nobody gets excited about soil sampling. And we had 6,000 soil samples collected on 12 properties with Eldorado Gold. And, most of the world was recovering from COVID and the market was in the doldrums and it wasn't a very exciting time anyway. So we did all of that work. It's required. We did all that work to provide the level of comfort to our funding partner that these targets had other merits. So there was historical work. I mentioned the 10 million that had been spent in the previous time by Golden Valley. That was certainly of value. It's all public information. But the soil samples that were collected take us to the point where now there's ground verification, geophysics, mobile magnetotelluric surveys, all kinds of fancy stuff on the ground that is becoming more interesting. But leading to your question is leading to drill programs on multiple properties. That becomes the first catalyst that should be of interest to shareholders. Once we're drilling, that does move the needle for junior mining companies, in particular if successful. But given we have 12 properties in these joint ventures with Eldorado Gold, we have only one that's been drilled to date. We've done 2 drill programs on it. One was just released 2 weeks ago. Great results. The next one is to be underway within the next 10 days in Ontario. That'll be the first drill program that we're the operator of. There's another 10 properties to follow in this. As each agreement vests, the royalty is created. That's the exit strategy that I'm trying to build with Val-d'Or Mining Corp, because that's what achieved success for Golden Valley Mines, Abitibi Royalties, Canadian Royalties. They were all sold as royalties companies. We're not trying to compete with Franco-Nevada. We can't. But we can create grassroots royalties. And if the geology and the targeting and exploration work are successful, it doesn't have to be successful on every property. It takes one. Well, Odyssey Mine is a good one. The Canadian Royalties Mine is a good one. The Perestroika prospect appears quite promising that we've tapped into with Eldorado Gold right now. And we have another 11 that are behind that. As each one vests, the royalties are created. They're typically 2% NSR. That goes to your earlier question. There's a few that have legacy royalties, and I don't think the aggregate allows us to go above 2. So some of them result in a 1% NSR to Val-d'Or and a 1% to the original staker or holder. But that's how we create the exit strategy, building royalties from within. We own 100% of a property. We end up with 100% of the royalty. Somebody else pays for all the costs.
Okay, and let's be really clear about the model is you don't need to wait until these royalties are paying, because you're selling to a royalty company like a Gold Royalty. I think that it was Gold Royalty, wasn't it? Yeah. So they like a certain kind of profile and size and scale of what you can put together. So at the end, what was Golden Valley Mines had, like, how many royalties, and how was that valued, and is that what you're working towards?
Right. Well, Golden Valley ended up owning 17 properties, royalties, which became the properties that are in Val-d'Or Mining Corp now for the most part. But Abitibi Royalties really only had one, and that was the Odyssey Mine. So when you have an Odyssey Mine, you really don't need to have a basket. It ended up having over 10 million ounces in resources measured and indicated by the time the transaction closed.
So is that how it's measured? It's like how many ounces with a 2% NSR on it? That's what gets bought. Is that what royalty companies look for?
Exactly.
Right. Okay. And is there kind of graduated risk profile to that? You know, if you had 100 companies, so one company with 10 million ounces, is that the same as having, 10 companies with 1 million ounces? Is the value the same?
Well, also a good question, because often we hear about so-and-so has crossed the 1 million ounce threshold. The first thing I always look at is that a singular deposit? Is that one zone? Is that in any way economic? Is it near surface? Is it underground? Will it be open pittable? Is it stacked on echelon quartz anchorite veins? What is the nature of that 1 million ounces? And if it ends up being, well, they're talking about a property the size of Manitoba, and they start at the Ontario border and end at Saskatchewan, that's not 1 million ounces. At least it's not a 1 million ounce deposit. So those are the things that, most people would look at as part of due diligence. But we try to build these projects in conventional domains. So the Abitibi Greenstone Belt, the larger Cadillac Fault Zone, where effectively all of the Agnico Eagle operations are based, the Destor Porcupine Fault Zone, Timmins right across to Quebec, where all of the northern deposits are located. And so those are the areas that are historical, where most of the historic exploration was concentrated. But most of the modern exploration is actually on new targets in between those areas. Nobody looked at them before. And Osisko were probably the first group to demonstrate that was a viable model by going south of the larger Cadillac Break, and that's where they developed the Canadian Malartic and Odyssey mine. First deposits that are material, anyway, that are south of that break. Everything else was to the north. So for 100 years, people just looked north. That's the way the industry is. The old expression, sheep look up. Well, everybody looked in the same direction, because how could they be wrong? They were successful.
So obviously that's going to inform your decision making, when staking, in terms of what information is available to you to say, like, I'm more likely to find that kind of profile of asset resource here. And even like post, say you've got an Eldorado and you're saying to them, look, we need to kind of do some sort of multi-element geochem geophysics here to refine our future drill targeting, like say Perestroika. You've got to very quickly get to a point of like, well, is this going to be useful to them? Is it going to be useful to us? Does it have any future value? Or so who makes that call as to how quickly you kind of drill to kill, as it were?
We have a technical committee that guides all of the exploration expenditures. So it should be no surprise they have the deciding vote. It's Eldorado Gold that fund, and ultimately they would end up with an 80% ownership or 100% of the property subject to a 2% royalty. But the technical committee is comprised of 2 members of Val-d'Or Mining Corp, 2 members from Eldorado, and together all of the targeting, the drill hole target selection, which surveys are deployed on which properties, where do we limit them? Do we cover everything with everything and spend unlimited, copious amounts of money because it's theirs? Or do we actually do what we would do if it was our own funding? And that's typically the way we present things to them. And to date, we're in the 4th year of the original agreement. Things have gone extremely well with them in the technical committee, but it's the technical committee that ultimately decides these are the properties that will be drilled next. This is the sequence, this is the chronology, and this is the quantum. And even if we sometimes wish that the quantum were quite a bit bigger, more drilling would be better. Results speak for themselves. So the best example is Abitibi Royalties. The agreement required Osisko to spend $2 million to earn 70%. They've now spent $4 billion on that property, building the Odyssey mine, etc. The only reason they went past the $2 million was because the results spoke for themselves. They vested and they kept spending because geology and shareholders had expectations. So we try to make our agreements typically easy to vest. Failure to me looks like agreements that default because we put the bar too high. So if we demand a junior company that's unable to finance spend X amount of money and they're unable to, and the property comes back to us, well, to me, that's failure. I didn't get the number right. We don't want to pay for the claim renewals. We don't want to pay for the ongoing exploration. And if we've already tested the best targets with their funds, we definitely don't want the property back because we can't pretend it hasn't been done before. So nothing substitutes for the geology itself. That's what determines where the next disbursements go from our partners.
Right. So that's their money. But for your money, in terms of where you would expect to be able to help, control the step changes in valuations of your company. Yes, through the drill bit with someone else's money. Absolutely get that component. What about how do you measure yourself? What are your kind of key performance indicators when it comes to generating value creation and step change in stock? Is it, new earning deals? Is it royalty creation rate, discovery rates? I mean, what are the things that
all
you
of that
set
is
out
true,
for
but it's
yourselves?
driven by commodities. So right now,
okay.
the price of gold trumps everything. So there's really no point to getting cute with lithium projects and so on. They've had their moment. They no doubt will again. Today is not that moment. And so there isn't much of my time or our office's time that's ascribed to looking at lithium projects, grassroots lithium projects right now. But gold projects, definitely. That's what keeps everybody particularly busy right now. The demand is there. The partners are looking for more. If you think about it, with the price of gold touching new highs almost daily, and Val-d'Or being a classic Canadian gold mining town, what better business is there for a gold miner than to be paying your expenses in Canadian dollars, getting your revenue in US dollars in a commodity that's increasing from day to day? This is the perfect storm for gold producers. So they're looking to enhance their pipeline of exploration projects, pipeline of development projects. And that's exactly the type of frenzy that is, appearing in the industry right now, the top down. Hasn't touched the smallest of the juniors yet, but it's definitely apparent for the developers.
Okay. And just finish off with this. I mean, if you could just talking to not just your shareholders, but anyone else looking in at this kind of business model, I think we've done a good job of explaining, the benefits of it. But, in terms of the time frame and timelines, what type of investment is this? I referenced it earlier as a kind of get rich slow, scheme. So, people need to set and manage their own expectations, but can you help them understand what that looks like?
Right. Well, typically what hurts junior mining companies is dilution. You have to raise a lot of money to test these ideas. And if you're a prospect generator, you have a lot of properties and therefore a lot of ideas, and it requires copious amounts of capital, which implies dilution. So we've tried to build a better mousetrap. How do you find the capital that allows you to test a basket of properties on a multitude of commodities, not just gold or precious metals, but from time to time we've worked in diamonds, uranium, nickel, copper, platinum group elements. If sand were economic, we'd be looking for that too, but gold is the one that drives the bus right now. So dilution is what we're trying to avoid. The way we do that is we bring in partners. We bring in partners to do the heavy lifting, the expensive part of exploration, to avoid dilution. And we do have a fan club of sorts. There are people who have done well over the past few decades with our little group. We have 4 10% shareholders in Val-d'Or Mining Corp. There aren't many companies with a capital structure like us that can say that. I'm one of them. My original backer with Golden Valley Mines is one of them. Gold Royalty Corp is one of them. And the Quebec government financial institution, SIDEX, is one of them. And so our retail is important because it represents 60%, but that's the part that was beleaguered, flattened over the past 3-4 years. And so they were looking for disclosure. Well, what are you doing? Well, we were collecting thousands of soil samples and doing all of the necessary groundwork to build a case for drilling. And I think we've hit the perfect climate. So right now our partner has a voracious appetite for ounces. They want to increase the throughput at the Lamaque mine in Val-d'Or and acquire other assets in the Abitibi. And we're a very large holder of mining properties in the Ontario side, and that's become attractive to companies like Eldorado Gold in particular, but lots of juniors. The hard part is to find companies with the capital structure that have sustaining power.
Glenn, Appreciate your time today.
Yeah, you too. It's always good to talk to you, you know.
Yeah, well, I think we've learned a thing or two today, and also kind of good to see you back in the saddle in a market like this. Stay in touch and let us know how you get on, okay?
Yeah, you bet. And don't be shy. Just flip an email if you're looking for something or something didn't come across. Just ask me and I'll tell you what you need.